Oh, yeah, yours good.
Okay. So thank you guys for joining us today for the second live review exam. So today, Amber, Chris, and I are going to walk you through the most important points that we covered in units 3 and 4, and just to help you better prepare for the exam. Okay? But the most important thing is that please do not just rely on this review session. You still need to go back and review all the required reading materials that provided on Blackboard. Okay, so make sure you just go back and review all the materials in the unit folders. All right, so first of all, about the exam structure, just like the previous exam, we will have 50 questions for a total point of 145 points, and you will have 90 minutes to complete the questions, the exam. So if don't postpone to take exam to the last minute, until the last minute. So it's better to, if you want to have 90 minutes full, you need to at least start taking exam by 10:30 p.m. tomorrow night, okay? So in this exam, we will cover units 3 and 4, and each unit has 2 goals. So basically, we have 4 goals, 25% of the exam for each of them, and also the questions are multiple choice or true or false questions, just like the first exam, okay? So, you need to, it doesn't change the slide.
It's just a little bit of the way it looks like on your screen.
All right, so we have some tips we're studying for you. So first of all, you need to, like I said, go back and read the required readings. So for example, unit 4 readings, you need to read the overview of leasing a vehicle, true cost of vehicle ownership, negotiating for a good vehicle price, and also the cost of ownership. And you know, the same for the unit 3, you need to go over all these bullet points and these learning objectives in unit 3.
Just add to that. So these are documents that we've put together because we felt that there was a little bit of information missing from the book that really is needed to help you understand the material. So for instance, the first one about leasing a vehicle, if you don't read that, there are quite a few questions that you'll miss. It has a lot more information than the textbook does, so make sure to look through these. And they're really good for you to know as well.
Yeah. So also you need to review the participation questions, projects, and quizzes. Also, if you need, you can go back and review the discussions on the discussion board on each unit. All right, so let's start with the first goal. Goal 5, credit reports and credit score, and the difference between these two. The credit report is a report that includes your personal information, such as your name, social security number, age, address. Also, it shows that what type of accounts do you have, so how many credit cards you have, if you have a loan, what is your balance, if you have different credit cards, what is your balance on each credit card. Also, it shows the payment, your payment history for each of those accounts, all right? Also, it shows how many credit inquiries you have so far, and the credit inquiries can be either voluntary or involuntary, okay? So this is really important point. Also, it shows if you have a overdue payment, and it's basically the public record and the collection items. All right, so next bullet point is credit score. Credit score is just a numerical score, and it shows your credit worthiness. So the number is between 330 and 850. I don't know if you really need to know the range, but it's good to know. And actually, nobody knows how your credit score is calculated, but these are the most common and most important factors that we have. So the most important one is your payment history. 35% of your credit score is based on your payment history. And the next important thing is the amount that you owe. 30%, and after that we have length of credit history for 15%, and new credit and types of credit used 10% each, okay? And also reporting agencies. I'm pretty sure that you already know these because we had a extra credit assignment for credit reports. So we have 3 credit report agencies, Equifax, Experian, and TransUnion. And if you go to this website, you can get 1 free credit report each year from each of these agencies. So if you want to have more, you need to pay. Okay. So here we have some questions for you. So the first question says, what factors influence your ability to get a loan? Credit score, stable employment, stable residence, good collateral, annual income, current level of outstanding debt, marital status, or debit card use. Debit card use. So which one influence your ability to get a loan? Yes, credit score is right. How about having a stable employment? Mm-hmm. Yes, that's right. Stable residence? Correct, because it shows that you are, residents. You are living in the United States.
Well, it's not just that. So the fact that it's stable. So if you're moving from house to house, like say every 6 months or a year, does that look good or bad to a lender? Bad. Say you're trying to get a mortgage and you move every 6 months. They're probably not going to give you the loan, right? So they look to see that you have some stability in your life.
Yeah. Having a good collateral. Yes, of course. Annual income? Yes, that's right. How about current level of outstanding debt? Okay, so what about marital status? Is it important if you are single or married to get a loan?
Yeah.
No.
That's illegal, right?
Yeah, that's kind of discrimination. Also, using your debit card instead of credit card. Is it important? Not really. Okay.
So real quick, which of these items are on your credit score or your credit report? We have a lot of these that we checked off that influence your ability to get a loan, but some of these are not on your credit report, right? So what is not on your credit report?
Residence?
I think we have a
residence. Well, we're here. So. Okay. Residence is on there. So collateral won't be, right? So it's going to be depending on the loan. And then annual income. Mm-hmm. We'll get to that more later, I guess. Sorry. I'm jumping ahead.
All right, so these are the important points that may impact your ability to get a loan. So next question. Jim has a great credit score because he's always on time with his payments. He will definitely get the loan or credit he applies for.
False.
Is it true or false?
False.
False, that's right. Why is false? Because it depends on, many other factors. So having a good payment history is one of them, right? Not everything. So next question. Credit bureaus decide who should and should not receive credit. True or false?
What do credit bureaus do?
Manage credit.
They report. So all they do is report. Who decides whether or not you get a loan?
Credit unions.
What?
Banks.
Banks, credit unions, yeah.
Okay, so it's false. So next question. Your salary information is included in your credit report.
False.
And it's really important. Many students miss this question, so it's really important question. All right, goal 6. I will hand it to Chris.
Okay, so goal 6 is all about debt management. So we'll start off with the types of consumer credit. So there's an installment loan. So this is like your mortgage, basically. So with an installment loan, you repay at regular intervals at a specific date. But at first, the interest payment on that loan will be really high and won't be much to principal. As the life of the loan goes on, you'll be paying more and more to the principal and less to interest. So like I said, this is mostly a home mortgage. Can be some auto loans, but just mostly think home mortgage for this. Okay, so the single payment, this is like money is borrowed and repaid at an agreed upon date, but it's just one payment in the future. So you won't see a lot of these because the interest isn't compounding like it should during that. So most lenders don't perform this kind of loan. This is more like something that you get from your mom or your dad or maybe a family member. Just says, hey, I'm borrowing $5,000 and a year I'll pay you back $5,500 or something like that. Okay, so there's also revolving credit. It's sometimes called open credit. This is basically you have a line of credit extended to you up until a certain point, or like a maximum usually. And whenever you make purchases, you don't really have to get approved for it. You're already pre-approved. So this is like a credit card or a HELOC, a home equity line of credit. Okay, and the last is service credit. So this is like if someone repairs your plumbing or something like that, they'll perform the services without getting paid. They're performing the service on credit, and then you repay it back either in monthly payments or in a lump sum. Okay, so this section is about credit cards. There are two types of credit cards, secure versus traditional. Secured means that you back the credit card with some collateral. So maybe an asset that you have, a bank account, anything like that. So since it's secured, you'll usually have a better rate on these cards than you will with the traditional. The only downside is if you can't pay your balance after a certain amount of time, they'll be able to come after your assets and they'll take them over for their payment. So just be aware of that. Traditional is probably what you're more accustomed to. It has a little higher interest rate because it's not secured by anything. The credit companies are basically taking on a little more risk to loan to you because you don't have anything to back it up, so they're going to want a little bit more out of that. And with this one, most of the time you're going to have good credit to qualify. Sometimes you still will with bad credit, but they're going to give you such a horrible rate that you're not really going to want to use it. There are a lot of advantages to credit cards that people don't usually think of. I know there's a lot of negative association with credit cards, but they can be useful. They're very good at building credit, especially for people who maybe don't have any payments, like younger people. They're very secure, especially like with internet purchasing. It's a $50 loss limit versus a $500 loss limit with a debit card, so that could come in handy. Sometimes you can get deals with a credit card that you can't get other places. So when Paul McCartney came to town a couple of years ago, if you had a black card from American Express, you were eligible to buy tickets right then. So there's little stuff like that that people don't think of. And then there's also some warranties and stuff. So the negative side, though, it's easy to overspend with the credit card. So you don't see what you're spending unless maybe you look at your balance once a month. It makes it a lot easier to spend that way. They've done a lot of studies that show that people pay a lot more for an item if they buy it on credit versus paying out of cash, just because of the difference in seeing the cash come out of your hand versus putting it on a card. So there are going to be interest rates with credit cards you have to watch out for, especially with monthly compounding. It can kind of sneak up on you, and all of a sudden your balance is a lot more than what you thought it was. It's easy to get out of control with this kind of spending because you don't see the money. Okay, and then the last thing there is the Card Act of 2009. This was brought about to protect, basically protect anyone trying to get credit. A lot of it is more geared towards young people. There's a limit. So if you're below the age of 21, you can't borrow without your parents co-signing for you, basically. So this is there to protect you from credit card companies trying to come in. Say you're an incoming freshman, they'll have a table set up outside the sub or somewhere like that and say, hey, you should get a credit card. It's going to help you with all this. So they kind of established this act to keep lenders from being able to do that. Just remember, this act is there to protect you, so it's not really there to limit anything. So if you get a weird question on the exam, maybe trying to limit unemployed or something like that, this act does not do that. It's just there for protection. Okay. Next we'll go on to student loans. Okay, so the main types of student loans, or of educational loans, sorry, are student loans, parent loans, and then private student loans. So the student loans are going to be the best bet if you can apply for them and get them. There are three types. So the first is a federal Perkins loan. This one is based on students with exceptional needs. Because of that, it has a really good rate. It has a 5% rate. It's better than you can get with any of the other loans. And these loans also have the longest grace periods allowed. After that, there's a direct subsidized loan. So this is only available to undergraduates. That's a big thing. And so what the subsidized means is while you're in school, the government will pay your interest payments for you so that they don't accrue. This can really save you a lot of money, especially if you think over the course of 4 years, all the interest that you would save on a loan like this. It's important to know that interest will start accruing after your grace period, so you don't get this forever. It's only while you're in school and then through the grace period. Opposite to that is the Stafford unsubsidized loan. So this is not needs-based. They'll give this loan to pretty much anyone. It's an 8% or above interest rate, so it's really not that great of a rate. That's also partially why it's not needs-based. They're really just trying to make sure you have the money to get through school. And also maybe the government's trying to make a little money off of you too. These loans, the unsubsidized, are available for undergraduate and graduate. So just remember the difference between those two. Okay, the third type of loan is the parent loans. Second type. So these are available more for parents who have the ability to pay for their children's college, maybe didn't take the time to save, so they can take out this loan and just kind of slowly pay it off as they go instead of paying all at once. The PLUS loan is available for graduate students and parents as well. So remember that graduate students can take that loan out. There's a 6-month grace period on these. No, that's not right. Sorry, there's a deferral available for these of 6 months. And like I said, these are mostly just for parents who haven't planned for college. The rates on these are going to be in between the Stafford loans and private loans, so it still is a pretty good option just to get a little better rate. So the last option there, private student loans, this is going to be maybe you go through a bank or something like that. You want to use these only when you've exhausted all your other options. Your rate's going to be a little higher. You're going to have a credit check to be able to do that, to be able to apply for one. There aren't any grace periods, so you're going to be charged interest as soon as you take the loan out. And we also recommend shopping around for these kind of loans because you're going to have a different rate depending on where you go, depending on your credit score. Okay, so the grace period is basically the time between when you take out the loan and when you have to start repaying the loan. And so like I said, the Perkins loans will have the biggest grace periods, and then the Stafford subsidized.
Again, there's a really great table in the book. I can't remember the table number off the top of my head, but there are 2 tables about student loans, and one of them goes through all of these details that Chris was just talking about. I didn't put it on the slide because it doesn't fit. You can't read it, but I would have that in front of you during the exam. It really will help answer a lot of questions.
Okay, and one important thing to note about the grace periods is most banks won't have grace periods like this. And they will definitely eliminate the grace period on a new purchase if you don't pay your balance in full. So remember that. You might see that on the exam. Okay, there are 4 types of repayment plans for the government loans. So that's a standard repayment plan that's based on 10 years of equal payments. So basically, you graduate, whatever your balance is, we'll just run a time value of money calculation, figure out what your payment should be to get it paid off in 10 years. So that's the standard. That's mostly what you'll get unless you apply for the other ones. So you can also get an extended repayment plan. That's from 10 to 25 years. Just know that 25 years is the maximum on that. So this one is a little easier to get than the income-based, which is the second one. So the third. The income-based is based on a percentage of your income. So this is good, say, if you just graduated and can't find the job that you were hoping for maybe, so your student loan payments are going to be more than what you can afford, then you can try the income-based plan. Just know that when you lower your payment, that's not always a good thing. By doing so, then you're extending the time period that you have to pay, so in the long run, you're still going to pay more. So try to only use these if you're forced into it. Otherwise, you want to try to pay as much as you can each month. Okay, and with this kind of loan, after 25 years, there are forgiveness plans. This is all fairly new within the Obama administration, so that's good. They're at least going to help you. You know, they're not going to stick you in debt for the rest of your life. You'll never be able to get out of it. After 25 years, they'll say, okay, you've done all you can. They'll forgive the rest of your loans. The last type of loan is a graduated repayment. So this one, your payments will start low, but they'll increase every 2 years. And this one also has 25 years before debt forgiveness. Okay, so beyond these payment plans, there's also an option for deferment. You guys are really going to want to read all you can about deferment because there are quite a few questions about this on the exam. So deferment basically is if you're enrolled at least half-time in school, you're unemployed, or you meet certain hardship standards, you can postpone your payment for up to 3 years. The good thing about this is it doesn't affect your interest rate, and also if you're on the subsidized loan, your interest won't accrue. So a lot of people don't realize this is an option, and instead they'll miss some payments on their student loans. That's a terrible idea. That's going to mess with your interest rate. You're still going to accrue. All you have to do is apply for this deferment, and they'll freeze it all for you up to 3 years. So it's a really great option to use. Okay, so credit cards are types of installment loans. True or false? Somebody say false? Don't be tripped up on this one on the exam. Credit cards are not types of installment loans. Okay. Plus loans require a credit check. True or false? It's true. You're going to have to apply for this kind of loan just like you would a normal loan through like a bank or something like that. So you're definitely going to need a credit check. That's going to affect the rate that you get. Okay, what about this one? You can defer both subsidized Stafford student loans and unsubsidized. True or false? Those are. You want to think of these two. They're very similar. So you can actually defer both of those. What about this one? Rank the following student loans in order of lowest cost to borrow to highest cost. So we want the cheapest one first. So what's the cheapest out of the 4?
Subsidized.
Subsidized, right? And then unsubsidized. Plus. And the alternative. You're going to need to pay attention to this ordering for the exam. You'll have a couple of questions that ask you for the cheapest cost to borrow. Now I'll turn the presentation over to Amber for major purchases.
Okay, really quickly, because we finally found it. Go back to that slide. Okay, so for this one, oh, no. So table, oh, I forgot it already, 6 point. 6.7 and 6.8, and that's on page
194 and 195.
So you'll want to have those tables for the student loan stuff. Okay. There's so many slides between us. I wouldn't have gone back.
Don't forget this exam is pretty much open notes, so you can have that sitting there ready to go beside you. You can have printouts from this.
But make sure that you have it organized or you won't have time to look through it all. All right, so now we're going to talk about major purchases. They're fun, right? All right, so we have automobiles, housing, and mortgages. So when you're deciding about an auto, you can purchase, lease, or rent. Which one's the most expensive?
Purchase.
Purchase.
Leasing.
Leasing. Renting. Okay, so this one's easy to forget about, but if you rent, think about if you go to rent a car, if you're on a trip, you'll probably spend your entire month's lease payment on one day of rent, right? So for cars, renting is really expensive. So renting is definitely the most expensive. So which one's the cheapest? Purchasing or leasing? Leasing? Why?
I don't remember.
You're right. So with leasing, you're paying for depreciation because you don't get to keep the car at the end, right? If you buy it, you get to keep the car. At the end, you get to sell the car. You get money back. So it makes sense that if somebody else owns the car, they get to sell it back at the end, then you're not going to pay as much, right? It makes sense. So leasing is going to be the cheapest, renting is going to be the most expensive, and buying is going to be somewhere in the middle. So making the decision to buy or lease, it really depends on the person. A lot of people prefer to lease because then they can switch cars more often. Generally speaking, purchasing will end up being a better deal for most people just because you can use it for longer. You end up at some point the loan's paid off, right? You're done paying the depreciation, whereas leasing, those payments continue forever. So in the long run, purchasing can be cheaper, but at least initially, purchasing is going to be more expensive. So if you're going to purchase it, you can go with either cash or financing. Now, which one's more expensive? Please don't get this wrong.
Finance.
Financing, thank you. So financing is always going to be more expensive than buying with cash, right? You have to pay interest. All right. So if you want to lease, you can either do an open end or a closed end. Which one's more common? If you haven't read that document, you probably don't know. So any takers? What's more common? Yeah, 50-50 chance. Closed end? Yep. So closed end is going to be the more common. What's the difference between closed and open? So if you don't know, you want to go back and read this document right here. So there will be several questions on the exam, but there's not too many, but you may see a couple, and it's really good to know. The main difference between open and closed end is at the end of the loan, do you owe more? So the reason closed end are more common is because it's a fixed payment, kind of like a mortgage, and at the end, you turn the car back in. With an open end lease, you're going to pay a little bit less every month, but then at the end, if the car is worth less than what they estimated, you're going to end up owing the balance. So there's more risk involved. All right, so you always want to negotiate the best deal. So if you want, so some of the other documents you talk about negotiating a good price. We'll have an example of that later. You never just want to go with what they give you. Okay. So talking about, this is kind of what Chris was talking about. When you buy a house, at the beginning, you're paying a lot of interest. At the end, you're paying a lot of principal. So a large part of the decision about buying a house is going to be time. If you're going to move in the next 3 years, buying a house is probably not a great idea, right? But if you're going to live there for a long time, then it does make sense. Usually 5 years is about the minimum that anybody will recommend. If you're going to rent, then you definitely want to pay. Renting can be a lot cheaper up front, but you're going to pay a lot more in the long run, right? So who can give me an advantage of renting?
You move more often?
You move more often, right? Is moving a good thing or a bad thing? I hate moving. Anyway, maybe you like moving, I don't know. So it can be good or bad depending on your personality. But if you want to move frequently, then you're right, renting is definitely better. What's an advantage of buying?
Equity.
Build equity, right. What's a disadvantage of buying? You have to pay a lot for repairs, right? If your water heater goes out and you're renting, you call your landlord, they fix it. If your water heater goes out and you own it, you have to pay for a new water heater. All right. So definitely know the reasons why you would want one or the other. You may see a couple of questions about that. What are other considerations for buying a house? So you want to make sure that you're going to live there for a decent amount of time, right? You want to make sure that you have the resources to sustain your purchase. And what else? Before you buy, you have to have down payment, right? And good credit. That's not on my list, but it's also true. So you have to save up enough for a down payment. Okay. So when we're looking at mortgages, first of all, I do want to point out we're only going to look at traditional mortgages in this class. We don't talk much about FHA and VA. They are their own beasts. We're just going to talk about traditional. So if you see anything, if you're familiar with FHA and VA loans and you see any questions that you think might be slightly wrong, keep in mind we're looking at traditional only. So the loan to value, remember we said we have a 20% down payment. Well, that would be an 80% loan to value. Loan to value is going to be the opposite of what you pay. This is how much you owe on a loan. Private mortgage insurance, we've talked about that some. Hopefully you're all familiar with it at this point. So this is what you pay to insure the lender. This would be, I don't want to put 20% down on my house. I only want to put 5% down. And so as a result, the lender doesn't think I have enough skin in the game and they want insurance in case I default. So I'm going to pay an insurance company to insure that mortgage for the bank. So PMI does nothing to help me personally other than getting me into a house with a lower down payment. So if you see an exam question saying PMI protects you, it is us. We talked a little bit about points in the book. You're not going to see anything about points on the exam, but it is good to know. You can buy points to lower your interest rate. So if the bank says, I'm going to offer you a 5.2% interest rate, you could maybe lower that by buying points up front. Is this good or bad?
Good.
Good? You don't know because it depends, right? Yeah. So if you're planning on living in the home for the full 30 years of your mortgage, this can be a great thing. Lower interest every single year, that's huge. If you're going to move in 3 years, it's a terrible thing. So it all has to do with the amount of time you're going to live there. Closing costs, so a huge thing to consider when you're going to buy a house. Closing costs, it can be several $1,000s. So you have to save up your down payment, plus closing costs, plus enough money for maintenance and repairs. All right, PITI. Make sure that you understand this one for the exam. It is principal, interest, taxes, and insurance. Affordability ratios. These are the 28 and 36% of income. So remember, the 28% is how much your PITI can be, the maximum, and the 36% is all debt. If you calculate both of those numbers, are you going to go with the bigger or the smaller? Smaller. Right. So this is what the bank is saying is their maximum. So if they're saying that either of these is their absolute max, whichever one's smaller is going to be their max, right? Does that make sense? Okay. So fixed or adjustable rate mortgages. We talk a lot about fixed rate, right? Anyone familiar with adjustable rate? A little bit. Sometimes you'll hear people talk about ARMs, so adjustable rate mortgage, ARM. And this will be where you say, so it'll be 3% now for the first 5 years, and then it'll be variable after that. What's the risk with this strategy?
Jumps up.
It can jump up, right. So 5 years from now, the rate can go through the roof. So adjustable rate can be very good if you're going to live in the house for a couple of years and sell it. It can be really bad if you're going to live there long term, which is why most people will go with fixed. So if we're looking at a fixed rate mortgage, and we're looking at our PITI, will this be fixed for the life of the loan?
Just the principal and interest?
Just the principal and interest. So the principal and interest is the loan, right? That's the fixed component. Taxes and insurance will change. That's change. Sorry, my shorthand. Delta is change. Sorry. And will they change up or down? Up, probably. More than likely, they'll go up every year. Does this make sense to everybody? Okay. So these are taxes are property taxes on your house, so they're based on the value. Generally speaking, housing values go up. Not always, but generally. So taxes and insurance will go up every year as well. They're both linked to value. Okay. All right. So a problem. Joe buys a new car for $20,000. He puts $2,000 down and finances the rest through a 5-year loan at 5% interest. What is his monthly payment? What's our present value?
$18,000.
Why?
$2,000 down payment.
Right. So it's $20,000 minus the $2,000. You have $2,000 down. Is $18,000. Is this positive or negative? Negative. Did I hear any other answers? Everyone thinks it's negative?
No, it's positive. Positive.
Yes. So this is positive. Why is this positive?
You're getting a loan.
Okay. So I want you to draw a clear line in your head. There is a purchase of a car and there is a loan. These are two very, very separate components. So on the car purchase, you're right, you're spending money, it's negative. But we don't care about the car purchase. We care about the loan, right? So ignore the purchase. The bank is giving you $18,000. You can do something with it. Now you're spending that, but you still have a car worth $18,000, right? You have $18,000 worth of something. So that's a positive. Now it's easier to remember if you think about payment. Is payment positive or negative? Payment's negative, right? It's money going out of your pocket. That's easy to remember, right? So if you can't remember the present value, think about the payment. Payment's negative because it's money leaving your pocket. Or general rule of thumb, if it's a loan, present value is positive, payment is negative, and future value is?
Zero.
Zero. That's the goal, right? Okay. Payment's what we're solving for, right? It says monthly payment. What's our interest rate?
5 divided by 12.
5% divided by 12. Perfect. And why are we dividing by 12? Monthly payment. Okay, and this would be 0.41667. You remember 5 divided by 12, and then press IY on your calculator. Don't round that number. And what is N? 5 times 12, right? Okay, so if you plug all of that in your calculator, you should come up with a negative $339. And I think that says 68 cents. All right. So try that out at home. The recording should be available shortly after we end here. Should get the same thing. All right. What is the minimum down payment needed to avoid PMI? 20%. So what is the what's the maximum loan to value? 80%. Right. So remember, 80% is going to be the opposite of this. So you could see a question that asks it either way. It could ask about the loan to value, or it could ask about the down payment. Luckily, if it says loan to value, 20% won't be an answer. All right. So if Troy has a gross monthly income of $5,000, he has a monthly payment of $350 on his car and $150 on his student loan, what's the maximum monthly PITI that the bank will give him? I'm just going to kind of walk you through how I would set this up. So there's two different ways we have to solve this problem. We have to do it both ways every single time. So we start with $5,000. Oh my goodness. And multiply that by 0.28. Remember, if we're doing this in our calculator, we're using decimals because it's not time value of money. And so that will get us to 1,400. This is our maximum PITI for just debt, or just the PITI part. I can't talk today. The second ratio is that 36%. So if we do the 5,000 times 0.36, we get 1,800. What is this 1,800? That's the maximum of all debt, right? So if this is the maximum of all the debt that we have, we subtract out the 350 and the 150 because these are the current debt payments, and we come up with 1,300. So this 1,300 is the max PITI. So for Troy, what is the maximum PITI the bank will give him?
1,300.
1,300, right. I can pretty much guarantee 1,400 is also going to be an answer choice. So don't just solve one way. Make sure to solve it both ways because you want the lower number because that's the maximum that the bank is willing to give you. Do you have a question?
Just asking where the 0.28 and the 0.36 come from.
Those are just standard numbers that you'll want to remember. They're in your textbook. Those are the numbers that every lender will use. Is that in the Card Act? Just put those, or was that before that?
I think that was before that.
I can't remember the act that created those numbers, but those are just standards that everyone will use. With any other questions on mine? Okay. Okay. So how about this one? Meg wants to negotiate on a car with a $42,000 sticker price. If the dealer's cost is 15% lower than the sticker price, and the best deal you can negotiate is 5% above the dealer cost, what's the price going to be that Meg can negotiate? How would you start this problem?
42,000 times 0.15.
Okay. So that gets you to 6,300. And what is the 6,300?
The dealer's cost?
Sorry?
Which you would subtract to get to the dealer's cost.
Right. So you would subtract that. So minus 6,300. And you get 35,700, and that's the dealer's cost. Okay. So can you negotiate down to 35,700?
No.
No, because they need to make a profit, right? So what do you do to that number to get it to what you can negotiate to?
By 0.05, and then subtract what you got from there.
Yeah, so if we multiply that number by 0.05, we get 1,785. So that's going to be the profit that the dealer wants. So if we add that number back in, so 35,700 plus 1,785 gets us to 37,485. It's simple, right? So if you see a problem like this, they're pretty straightforward. Just kind of think it through. Remember, think logic and then apply content, right? Okay. So we talked about this one a little bit. Who remembers what type of lease will require you to pay the difference if you return the car and it is worth less than the estimated amount?
Open-end.
Open-ended lease. Perfect. And these are really common or not common?
Common.
Not common. Perfect. Am I going too fast?
No, I think I remember the question.
Okay. All right. Another time value of money problem, right? What's tricky about this problem? Okay, let's set it up. So Lori's paying $40 on her credit card. She has a balance of $3,000, interest rate of $24.99. She wants to pay off the card in 3 years. How much more will she need to pay per month? So if we set this up, so years, we have 3 years times 12 months, right? So 60 months. Interest rate, she's paying $24.99. Monthly is 2.0825. Future value?
0.
I think it's supposed to be 36 months, right? Not 60 months.
Yeah.
Thank you. Yes. 3 times 12 is 36, right? Okay. Thank you. What is the future value?
0.
0, right, because the goal is to pay it off. Okay, what's the payment?
40.
Right now,
40. Okay, and that's negative, right? And our present value is 3,000. Now, do you see what's wrong?
Ooh.
Just forget about the payment and just solve for it.
Right, so we want to know how much more she's going to pay per month. So in order to figure out how much more we need to pay, first we have to figure out how much she has to pay in total, right? So if we put in this $40, we can't solve anything. So we have to take out the 40 and solve this. So CPT, and we come up with 119.26, assuming, of course, I can do math. So if we calculate, oh, geez. Is this $119, is that our final answer?
No.
How much you want to bet that's going to be a choice on the exam?
100%.
Okay, so 119.26, and she's already paying 40, so we subtract the 40, and we come up with $79.26, and that's the final answer. Now, one caution, 119 is going to come out negative on your calculator, right? Okay, so if you leave it as negative and you subtract 40,
159.
Yeah.
right. So if you write out your steps, you see 119, and then you minus 40, and it gets bigger, you did it wrong, right? Okay, so make it positive, and then subtract the 40 or add the 40. Just make sure that it gets smaller. Okay. Sanity checks, right? All right. Well, here's a long one. Okay, why do many borrowers prefer conventional mortgages? Because they include taxes, insurance, and the monthly mortgage payment, so homeowners don't have to worry about paying these items separately. Because they tend to offer lower interest rates than other types of mortgages, so homeowners pay less to borrow money. Most homeowners don't prefer conventional mortgages because they are expensive and more risky than other types of mortgages, or because they offer fixed monthly payments for the life of the loan, so homeowners can budget more easily.
The last one?
Last one? Okay. So let's look at this first one. Is this right or wrong? Do conventional mortgages include taxes and insurance in the monthly payment? Yes, they do. That's a huge advantage to a mortgage, right? You don't have to pay taxes and insurance. So you don't have to worry about paying them. Okay. So this one's right? Because they tend to offer lower interest rates than other types of mortgages. Do conventional mortgages have lower rates than other types of mortgages? Okay, so remember, we're comparing this to an ARM, right? Adjustable rate mortgage. So it's going to be low at the beginning, and then the rate's going to go up because it's going to be variable. So if you think about it, that's risky for you, right? Which means you're going to get a better deal up front. So this is more risky for the bank because it's fixed for life. So are they going to have a larger or a smaller interest rate? Larger, right. So this one's false, right? Okay. So most homeowners don't prefer conventional mortgages because they're expensive and more risky? Kind of just talked about that, right? That's false. They do. And how about this last one? Because they offer fixed monthly payments for the life of the loan so that homeowners can budget more easily.
I'm going to guess that that's incorrect.
Incorrect? Okay. So they do offer fixed monthly payments. Remember, we're looking at just the mortgage component of it. The mortgage component is fixed. So this one is true. So this is why I wanted to bring this up. It looks like there's two right answers, correct? But remember, we're comparing conventional mortgages to some other type of mortgage, so an ARM or a balloon or something else. This first, I'm not going to circle that. This first one, is this unique to conventional mortgages?
No.
No, this is not unique to conventional mortgages. This is unique to all mortgages. So it's incorrect in this example because of that comparison. So remember, to answer the question that's being asked, we're asking about a comparison. We're not asking about a mortgage in general. So this last one is the right answer. Okay. All right, so the final goal that we have, goal 8, calculating borrowing costs. This is project 4, right? Everything on here is what we did. We spent an entire project on it, so it's really important. So I hope that by now it's starting to make sense. The really, really important thing here is pay attention to what the problem is asking you. Are you being asked to calculate the finance charge or the total cost? Okay. So if you have total cost, remember there are 2 different formulas that you can use, and both of them will get you to the same place. Now, if you are looking at a car with a rebate, remember if you use this first one with a rebate, rebate, it's going to mess you up. So if you have a rebate involved, make sure to use the second one, because then you won't accidentally add back the rebate. Okay. If you have questions about that, make sure to visit your discussion board, ask questions about it if it hasn't been addressed already. I know I talked about it in my phone. Okay. So if Larry wants to buy a car that costs $30,000 and he has a 3-year, 2.5% loan, what is the total cost of the loan? So in this, we want to look at what is the total cost. So present value is $300,000, right? Interest rate,
30,000.
oh, come on, guys. No fun. I'm a $300,000 car. Thank you for keeping me honest. So the interest rate, 0.2083%, so that's 2.5 divided by 12 because we want monthly. So this doesn't actually say monthly compounding, does it? Okay, is a bank going to give you a car loan compounded annually?
No.
No. So it's going to be monthly. Should say that on the problem, though. So N is 3 years times 12 is 36. And payment is, oh wait, future value is 0. So payment is $865 and 84 cents. Okay. So found a payment. We're done, right?
Yeah. No.
What do we do?
Multiply the payment by the number of periods.
Perfect. And that gets us to $31,170.29. What's this number?
Total
The total
cost
cost.
of the loan.
Total cost of the loan, which is what we're looking for, right? Perfect. Now, if we had a down payment here, and this asked for total cost of the car, we would add the down payment back, right? Okay, but we want to know the total cost of the loan. Okay. So same question, but now we want to know what is the total interest cost. Remember, interest and finance are the same thing, right? They're both interest. So same problem as before. So we have the 31,170.29. That's the total cost. How do we get to the interest cost?
Subtract
Subtract the
the
cost of the car.
initial cost of that.
Perfect. 300,000, right? 1,170.29. Okay. On this problem, how much you want to bet this is an answer choice? Right? Okay. This is the answer. So make sure that you're answering the problem that you're asked. Okay. Same thing, but with a down payment. I'm not really going to go there for time. And that one is the house. Okay. So you can work those last two on your own. Okay. So final tips for studying, know the credit score pie chart. So that little graph that we showed you, make sure to know your percentages because you probably will see questions on the exam about those percentages. And they're looking for exacts, not approximates. Know the difference between a hard and a soft inquiry. Know the difference between a credit score and a credit report. Which one did you get for your extra credit assignment? Report, right. And which one has information that you really need to know? Sorry, I heard something. Anyone want to answer that?
Credit report.
Okay. Which one?
Credit report.
Report. Yeah, so the credit report is the important one, right? This one gives you all the details. This is where you can locate fraud. This is what you need. The credit score is great, but it doesn't tell you anything until it's too late. Understand deferral. Again, look at those definitions in the book on the table 6.6 and 6.7. Understand the difference between closed and open-end leases. Be familiar with time value of money problems, and know how to calculate loan to value and what is and that 20% required to avoid PMI.
Actually, there are 6.7 and 6.8.
6.7, 6.8. Did I write down the wrong ones earlier?
Yeah.
Oh, sorry.
Yeah, you got it right.
There you go.
Oh, okay. I just can't remember now. Okay. Thank you. It's late. I'm a morning person. And here are some calculations that you are likely to see. So make sure on your own that you can go through every one of these calculations and that you know how to solve for it. On the exam, pay attention, answer the question that you're being asked, and always remember to use logic first and then apply your content. A lot of the common mistakes on exams are based on people forgetting about logic. Okay, that's all I got. Questions? I'll put it back on this page if you want to read that.
The minimum down payment is 20%, right?
To avoid PMI, correct. And you can get a house with lower than 20%, right? But you have to pay PMI.
Yeah.
Right. Other questions?
I have a question about a rebate loan. At the very end, when you're adding the down payment back in, you don't add the rebate back in.
Correct. Because you get to keep it, right? So why did we subtract the rebate from the purchase price to find the present value?
That's what they're giving back to you.
All right.
Because that's what they're going to give back.
Right. So we want to be able to compare the two, right? We want to know how will it affect us. We have to subtract that so that we know how it's going to affect us personally. We can't factor in how it's going to affect us if we're going to spend it. Other questions? we'll hang around for a while. If anyone has any other questions, let us know. And then that, good luck. Well, you don't need luck because you're going to study really hard, right?
I may ask you to do another PITI calculation. You just make one up really quick.
Do I have one in here that is? Yeah, there's a blank page right here. Pick one up.